One of the most common issues whenever it comes to equity compensation is being blindsided by a huge tax bill. And so in this video, I'm going to go over some of the most common gotchas with the different kinds of equity compensation and how to estimate how much more taxes you owe, and then also when and how to pay those taxes. All right, let's get started. Before we get into all the different kinds of equity compensation and the way that taxes work with those, first we're just going to set the baseline scenario of you work for ABC company and you're getting paid a salary. And so whenever you first start for the company, then you're going to fill out a form called the W-4, and that tells the company how much to withhold from your paycheck to pay for taxes. And so in our example, we're going to say that this is a single person and that based on their W-4, then they're going to withhold $35,000 for federal taxes. And then what happens after this is whenever you go to file your return for this previous year's taxes, then you work through your return, and then there's a certain tax liability that you have. And then, so in our example, let's just say that your actual tax liability is $33,000. And so then that just gets compared with how much is withheld. And since we've withheld enough, then you get refunded anything more. And if you haven't withheld enough, then that's whenever you owe more taxes and have to pay that whenever you file. So far, nice and easy, but once you introduce equity compensation, then that's whenever things start to get complicated. And so here are some of the most common gotchas whenever it comes to equity compensation. The first one that I'll talk about, and is probably the most common, is whenever RSUs vest. And so we're going to say that this person also has 1,000 RSUs that are going to vest in March for this year. And that on the date that those RSUs vest, we're going to say that the price of ABC company stock is $50 a share. So when this happens, then the way that it's handled from the company's perspective is that this is considered bonus income or supplemental income. And so companies will generally do a flat rate that they are going to withhold on this money. And so that flat rate is for, as long as it's less than $1 million, is 22%. And one thing that I want to make sure is clear with this is that this happens just with the RSUs vesting. So this happens regardless of whether you actually sell the RSUs or not. So the next thing is talking about some of the tax consequences for whenever you actually do sell your company stock. And let's just say for this example that our RSUs vested, but then we actually haven't sold any of them. But then a few months later, the stock price goes up, and then we do sell it for $10,000 more than the value of it whenever it first vested. So in this scenario, you would go into your equity account, your brokerage account, and you would sell, and then the proceeds of that would all come home and nothing would actually be withheld by the company. The one point I want to reiterate with this is, I know we just talked about doing this with the RSUs, but this is the situation with any stock that you sell. The next gotcha has to do with non-qualified stock options. And so just as a quick reminder of the way that non-qualified stock options work is that as soon as you exercise them, then that difference of whatever the stock price is of your company's stock versus the strike price or the exercise price of those non-qualified stock options, any spread is considered income to you. For this example, let's say that the company stock price has gone up and it's now $60 a share, and then we have 1,000 non-qualified stock options that have a $10 strike price, and then we want to go ahead and exercise and sell all of those. When this happens from your company's perspective, then they're going to treat this difference the same way that they do with any other supplemental income, like so with the RSUs vesting, and so they're going to withhold taxes at that flat 22%. So if we just pause here before going any further, then whenever we first started, we filled out our tax return and it was about $33,000. But in this scenario of if this is a single person and they have these other things happen, then whenever you actually put that into a tax projection, then the tax liability turns into about $71,000. And so compare that to how much is actually being withheld, which is $57,000, then you can already see the shortfall that we have and the surprise that's already starting to happen. So where it really starts to get out of control is whenever we introduce incentive stock options. And so before we talk about this specific example, then let's drop into understanding the way that incentive stock options are taxed. So here is a visual to talk through how ISOs are taxed. Whenever an ISO is granted, then it has a strike price. And then on the date that you exercise it, if you were to immediately sell it, then the difference between the strike price and the fair market value at exercise is all considered income. So that's just the same as with non-qualified stock options. But if you choose to hold on to the incentive stock option, then from that point, if it's sold later after the stock price has gone up, then anything above the fair market value is short-term capital gains, and if it goes below, then it just lowers the amount of income that's realized. But the tax benefit of ISOs is if you hold it a year past exercise plus 2 years past the grant date, then it becomes qualifying, and that means that everything above the strike price is considered long-term capital gains. The other notable part about incentive stock options is this spread, whenever you exercise it, is considered your bargain element. And so if you exercise an option and you hold it through the calendar year, into the next calendar year, then this spread that happens at exercise is considered AMT income. Back to this example, let's say that this employee has 5,000 incentive stock options and that they have a $10 strike price. And so at the $60 a share, they're wanting to try to exercise and hold as many of these ISOs as they can to get that preferential tax treatment, but then also doesn't want to have to bring any money to the table. And so they do something called a cashless exercise. So in our example, what we've done is that we've gone ahead and exercised and immediately sold 1,000 of those ISOs, which created $50,000 of regular income, but then we're going to exercise and hold on to 4,000 of those ISOs. And so I put this 200,000 in parentheses because this doesn't actually count as income in the normal way that all this other stuff does, but it's important because it's considered income in the AMT calculation. And the reason why it gets out of control with ISOs and where it gets people in trouble is because for incentive stock options, for both exercising and selling or exercising and holding, then by default, your company isn't going to withhold any taxes at all. So now if we circle back to doing what we did at the very beginning with just our salary, and we go and we're filling out our tax return and we're adding up our salary and then our RSUs, and then we had our non-qualified stock options, and then we also did this with our incentive stock options, then what this tax liability is going to show is a tax bill of about $127,000. And so whenever you compare that to how much was withheld by default, then that gives you about a $70,000 tax liability. As if owing $70,000 isn't enough of a kick in the pants, then what can happen is with that level of underpayment, then you would also be issued an underpayment penalty that gets included into this tax return, and that can be upwards of $3,500 in this case. Now that we've established that all this kind of equity compensation can lead to a tax liability that isn't covered by the standard withholdings, then you got to figure out how much do you owe. And so ideally, if you have all this stuff going on, then I would encourage you to work with a tax professional to run estimates for you. But if you do want to figure out how much you owe, then the first step is to understand the different kinds of income that you are creating. And so first, under the category of ordinary income, there's going to be your salary, obviously, and then RSUs vesting, the non-qualified stock options, exercising those, exercising and selling incentive stock options. And then also, and we didn't really talk about this, is if you have an employee stock purchase plan, then the discount from that is also considered income. Then next in a similar category is short-term capital gains, so that if you sell stock that you've held for less than a year, then that's considered short-term capital gains, and that's going to get taxed at the same tax rate as your income. And on the subject of selling stock, that if there's any stock that you've held for longer than a year, then that actually goes into a separate tax rate for long-term capital gains. And so that's for stock that you've held for longer than a year, or for those incentive stock options that you've exercised and held for over a year, then that spread that's going to be at long-term capital gains as well. Once you've totaled all those up, then understand where that puts you into your tax brackets, and so figuring out what that last tax bracket is that you go to, which is called your marginal tax rate.
I'm actually going to break in here real quick to go a little bit more detail into how the tax brackets work, because it's a pretty common misconception of exactly how it works. And so first, if we just have our base scenario of just having the salary, the $180,000 of salary, then that shows up here as part of your total income. And then actually you would subtract out deductions. And so just for the sake of ease, we're just going to do the standard deduction. And this is a 2023 tax estimate. And so with subtracting that out, then our taxable income is $166,800. And so then with that taxable income, that's what you compare into these marginal tax brackets. So we see that we've almost filled up the entire 24% tax bracket, and we have about $6,000 of room left over. And so whenever you add any more income on top of that, then the last bit is going to fill up the 24% tax bracket, and then the next about $50,000 or so will be taxed at 32% here. And then anything above that gets into the 35% tax bracket. In our particular scenario, whenever we have our salary and then we add the $50,000 of RSU income and then the $50,000 of non-qualified stock option income from exercising those non-qualified stock options, and then also the $10,000 of short-term capital gains, then that gives us our total income of $290,000, subtract the deduction, and so our taxable income gets to $276,000, which is in the 35% marginal tax bracket. But thinking through how it actually goes through those tax brackets, that first $50,000, say for the RSUs, was taxed at 32%, and then the non-qualified stock options got taxed at that 35% tax rate.
Now that we know our marginal tax rate, then if you think of the things where it's just under withheld, so like these RSUs vesting or the non-qualified stock options vesting, so those were withheld at 22%, and then let's say if your marginal rate that you're at is 32%, and then there's an extra 10% that you need to that you will owe on those. And then for the things where nothing was withheld, then if it's something that's either short-term capital gains here from selling this, or that it's income from exercising and selling ISOs, then you would take this number and you'd multiply that by that marginal tax rate. I don't have anything here for the AMT income for exercising and holding, because honestly, in that scenario, I would say just work with a tax professional, because the AMT calculation is too complicated to try to figure out, kind of a ballpark figure like this. Now we know how much we owe for taxes, then the next question is, when do I actually have to pay these taxes so that I can avoid getting this extra penalty? And so that is based on a few different things, and the first thing that you want to look at are something called safe harbor rules. And so what those are is to say, if the regular company withholding, if it hits one of these limits, then even if you owe $70,000, then you don't have to pay it early and you won't get that underpayment penalty. The first safe harbor rule says that if this withholding is either 90% of your current year's tax liability, or you owe less than $1,000, then you've hit that one. But in our example here, since our tax bill is $127,000, 90% of that is about $114,000, and we have not withheld that much, and so we don't hit that safe harbor rule. The other safe harbor rule, which does get hit sometimes, is you can look at your previous year's tax return, and if you withhold enough here to equal 100 or 110% of last year's tax liability, then you've satisfied that safe harbor rule, and you won't have any underpayment penalty. If your withholdings hits that mark, then you don't have to send money in advance to the IRS in order to pay your estimated taxes, and you can just pay the full bill, in our case our $70,000 bill, whenever you file. You can go ahead and pay that in advance just to get it out of the way, but otherwise I would strongly encourage you to just leave that money into a safe place, because you're going to need to send that just whenever you file your taxes next year. So what are the options if you're not withholding enough? Then the first thing that you can do is, if you're actually not that far away, so like in our example, if we just say we just have these RSUs and we need to withhold a little bit more in order to hit this, then one thing that you can do is you can update your W-4, how much you tell your company to withhold from your salary, and try to bump this number up so that you're withholding enough to satisfy that tax bill. Another thing that I know that some companies do, such as Google, is that they actually give you the option of changing the percentage that is withheld whenever your RSUs vest. And so instead of that default 22%, you can actually tell the company to say, hey, instead withhold 35%. And if all else fails and you don't satisfy this stuff, then you should be sending estimated tax payments to the IRS. And so the way that works is that you are supposed to send the money for those payments in the quarter that the money was earned. And so in our example, whenever we talked about the RSUs vesting in March, then that's a first quarter thing. And so this extra payment should be sent before the Q1 deadline. And finally, now that we know how much we're supposed to pay and when we need to pay it, then the last step is how to pay. And the easiest way to do that is to go online and go through the IRS Direct Pay website to submit your estimated payments. I know this was already a lot of information, but one last thing that I feel like I have to mention is thinking about state taxes and not forgetting about your state taxes. It's usually less of a problem of underwithholding on the state level, but these different actions that there are no taxes withheld, then you do want to make sure that you understand the state tax liability of that. And if you need to submit estimated payments to your state, then I would also encourage you to look for the online option for that. Thanks for watching. If you found this useful, then please consider subscribing. Share this with anybody else that you think would find this beneficial. Add it to your company Slack channel. And if you would like more information about me, then you can go to javawealth.com, and I will talk to you guys later.